The Australian housing market is doing something it hasn't done in over a decade. Sydney and Melbourne prices are going down. Brisbane and Perth prices are going up. The RBA has completely flipped. Everyone expected rates to drop this year. Instead, they're going up. 3 to 5 rate rises are forecast, and your home loan rate could hit 7, maybe 8% by September. All prices have doubled. There's some serious talk about recession. The head of the Reserve Bank literally said the recession we might have to have. And if you're a first home buyer sitting there right now trying to work out what the hell to do, I completely understand why you're frozen, because nothing looks simple, nothing looks clean. So in this video, I'm going to cut through the noise. I'm going to show you what's actually happening and why. I'll show you what the 30-year data says about every time Australia's been through something like this, including a period where interest rates were at 17%, not 7.5%. And I'll show you the one number, just one, that should actually decide your timing. It has nothing to do with oil prices, the RBA, and it's definitely not what you think it is. So let's jump right in. All right, let's put some real numbers about the real cost of waiting. But I need to be straight with you first, because this number is going to look different depending on where you are. If you're in Brisbane or Perth, the cost of waiting is still real. Prices are still going up, roughly 0.5 to just under 1% a month. Not as fast as the boom years, but still pretty crazy. On a $900,000 property, that's a $4,500 to $7,000 a month price rise while you wait. If you're in Sydney or Melbourne, it's a different story right now. Prices have actually come down a little bit. Sydney's dipped slightly over the past few months, Melbourne a bit more. So in those cities, the prices are running away from you like it was. That's real, and I want to be honest about it. And this is the part not many people are talking about. Rent is going up everywhere. Rents are up 5.7% across Australia. There isn't a single city where rent is getting cheaper. If you're paying $700 a week in Brisbane, that's $36,400 a year going straight to your landlord. In Sydney at $850 a week, that's $44,200, and it goes up every year with your lease renewal. So here's the honest picture. Waiting costs you differently depending on your city right now. In Sydney and Melbourne, prices aren't running away from you, but the rent is still eating your savings every single week. And we're going to talk about what the oil crisis and rate rises actually mean for where prices go from here, because that changes things again. First though, the question I hear more often than not is, do I qualify anymore? Here's something you need to hear pretty clearly. Your borrowing power today is lower than it was 6 months ago, and it may drop further if the RBA keeps hiking. A couple both earning $90,000, say $180,000 combined between them, with 90 grand saved and no big debts, could borrow around $1 million to $1.30 million about 6 months ago. Today, with rates going up, banks are testing whether you can handle repayments at 9.5% to 10% in some cases, even though your actual rate is lower. That's their safety check, and it means that that same couple now qualifies for a loan closer to $900,000 to $950,000. Same jobs, same savings. 6 months later, it's $100,000 less in borrowing. That's real. That's $100,000 difference. That's a huge impact, and we can't pretend it's not. But here's what the same rate hike cycle also does. When borrowing power drops across the board, buyers exit the market. Not all of them, but some. That means less competition at auctions, and in Sydney and Melbourne especially, that means more negotiating room. In some cases, sellers who are already testing the market at inflated prices have to listen. Here's one thing that hasn't changed. It's which bank that you choose makes a massive difference, especially now. We had a nurse come to us last year. She went to a bank and was offered a loan of $480,000. We got her to $620,000 through a different lender who assessed her overtime and penalty rates completely differently. Same income, same deposit, 140 grand extra lending capacity. When rates are going up, that gap between the best and worst lender for the situation gets even bigger, because different banks tighten their rules at different speeds. If you've already spoken to one bank, you genuinely don't know the real number. Now the crash question, the 30 years of data, because you deserve an actual answer. And this data has actually gotten stronger, not weaker in the current environment. Australia's 30-year track record. I want to take you through every significant housing correction in Australia that has happened in the last 35 years, because we've actually had 5 of them, real ones. No, I'm not talking about prices going slower, actual falls. And given what's happening right now, this data matters more than it ever has. Correction number 1. The 1989 to 1991 recession. The Reserve Bank cash rate hit 17.5%. Not a typo, 17.5%. Unemployment hit 11%. This was the worst recession since the Second World War. And because you say, but the oil crisis and rate hikes today are serious, they are, but today's rates are projected to peak out at 4.75 to 5.25%. That's less than a third of what Australians faced in 1989. National housing prices fell roughly 10%. In Sydney, from 194,000 to 182,000 median house price. And crazy numbers aside, by 1995, the house prices were back to where they started. They were at new highs. Correction number 2, 2003 to 2005 Sydney. After 5 years of 62% gains, Sydney exhausted itself. Prices fell roughly 10 to 12% from the 2003 peak. The rest of the country barely noticed. By 2007, Sydney was at all-time new highs. Correction 3, the 2008 GFC. The entire global financial system nearly collapsed. America fell 35%, Ireland fell 50%, Spain fell 40%. What did Australian property prices do? National house prices fell 9%. That was in 9 months, and they were fully recovered in under 12 months. Why was that? Well, the Reserve Bank cut rates, 4.25 percentage points. The government pumped $10 billion in stimulus. The first homeowners grant was doubled. Australia threw everything at it and it worked. Correction 4, 2017 to 2019, the APRA correction. The banking regulator cracked down on lending. No more interest-only loans for investors. The Royal Commission into banks. This one actually made a pretty big impact. Sydney prices fell 14.9% from peak to trough. Melbourne fell 11%. 20 months of continued prices falling. If you bought in Sydney in 2017 at 1.15 million, by mid-2019, your place was worth around $970,000. That's $180,000 underwater on paper. But by 2021, 2.5 years later, you're at $1.4 million, a 22% gain from the price you'd actually paid. And today, well, you're at $1.5 million plus. Correction 5, the 2022 rate rises. The fastest rate rise cycle in 35 years. 4.25 percentage points in 13 months. ANZ predicted a 20% national property fall. What happened? 9.1% nationally and recovered fully by mid-2024. And here's what it means for you right now. Because if you're watching this in mid-2026, looking at Sydney and Melbourne prices softening and rates hiking, the pattern is playing out again. We're entering correction number 6. In every single correction, every one, if you bought Australian property and held onto it for 3 years or longer, you came out ahead. Every single time. Now, what does the current oil crisis and rate environment actually mean for where this goes next? Because this is the question everyone's asking and no one is getting a straight answer. What the oil crisis actually means for property. Here's the chain of events a lot of people worry about right now, and they're right to think about it that way. Oil prices above $100 a barrel means high petrol prices. Higher petrol prices flow into the cost of everything, from transport, food, construction materials, energy bills. That pushes inflation higher. Higher inflation means the RBA can't cut rates. It means they're going to have to hike. Rate hikes reduce borrowing capacity. Lower borrowing capacity means less buying power in the market. That's the pressure side, and it's real, and I'm not going to tell you it's not. But here's the other side of the equation that often gets missed. We still don't have enough homes. Australia is short by 200 to 300,000 homes right now. We're building 160,000 homes a year when we need 224,000. Higher oil prices make building more expensive. Some projects get shelved, so the shortage is getting worse and not better. And here's the historical record that matters. We've had 3 major oil price shocks in Australia's post-war history. In 73, there was an OPEC embargo. Oil prices quadrupled. Australian house prices didn't crash. They rose for the decade. 1979, Iranian Revolution. Oil prices doubled again. Australian house prices continued upward. In 1990, the Gulf War oil spike. Australia was already in a recession, the one with the 17.5% rates. Prices fell, but as I mentioned before, they fully recovered within 4 years. So what's the likely outcome for first home buyers right now? In rate-sensitive markets like Sydney and Melbourne, prices stagnate or drop slightly. They're already dipping. The oil crisis accelerates that softening a bit, but a supply shortfall of 200 to 300,000 homes puts a floor into the market to prevent just a free fall. In supply-constrained markets like Brisbane, Perth, Adelaide, prices keep growing. Fortunately, more slowly than the 2021 to 23 boom, but they keep growing because people need somewhere to live and not enough supply is coming through. For first home buyers, here's the honest summary. Prices aren't running away from you as fast as they were, but rates are making it harder to borrow. It's a different kind of squeeze. The problem hasn't gone away, it's just kind of changed shape. And the international comparisons, what about Canada, New Zealand, everything else? The ones people raise all the time are the next thing I need to address. The international comparisons. Right, so this part is what I get a lot of pushback on in the comments, so let me take each one seriously. Canada. Canada's housing market has been falling since 2022. Prices are roughly down 17% across the country. The number of people falling behind on mortgage repayments in 2026 is being compared to what happened in America before the housing crash. So why didn't that happen here in Australia? 2 structural differences, and they're pretty important. First, Canada uses 5-year fixed rate mortgages. When rates rose, hundreds of thousands of Canadian homeowners hit a refinancing cliff. They went from a rate of 2% to over 6% literally overnight when their fixed rate ended. No buffer, no gradual assessment. In Australia, the vast majority of mortgages are variable. When the Reserve Bank increases rates, repayments go up gradually. Crucially, you can use your offset account to absorb that blow. The offset account is actually one of the biggest shock absorbers in the Australian financial system. Second, in Alberta and Saskatchewan, Canadian mortgages are now non-recourse. When a property goes underwater, you can just post the keys to the bank and walk away. Literally called jingle mail, no personal liability. In Australia, if you stop paying, the bank doesn't just come after the house, they come after you. Your car, your savings, everything. That completely changes how people behave. Australians fight to keep their homes. That's why we don't get waves of people just walking away from their properties when things go bad. Japan. Japan's housing market peaked in 1991. 35 years later, it's still below that peak in many areas. Prices fell 50% over a decade and never fully recovered. But here's what caused the Japanese crash and why Australia can't replicate it even if we tried. Japan's population is declining. In 2022 alone, Japan's population fell by 800,000 people. The birth rate of 1.3% against replacement rate of 2.1, zero immigration. In Australia, we grew by 518,000 people in a single year, the highest net migration in Australian history. Japan has 9 million vacant homes. By 2033, 1 in 3 Japanese properties is projected to be vacant. Australia's vacancy rate? 1.4%. The national housing shortfall is 2 to 300,000 homes and growing. The conditions that caused Japan's crash simply couldn't happen in Australia. We're the complete opposite. China. China has 50 to 65 million empty homes. Evergrande alone owned $300 billion worth of property and never delivered 1.6 million apartments people had already paid for. Their entire property industry basically imploded because the government had been using property building as an economic growth tool for decades. It was speculation on a scale that had never been seen before. Australia doesn't have ghost cities. We have housing queues. New Zealand. This is the one that actually matters. New Zealand is the one I take most seriously. Same culture, similar political systems, similar market dynamics, and this one actually happened. From the 2022 peak, New Zealand prices are down 16.2% nationally. In real inflation-adjusted terms, they're down 30%, back roughly to 2019 levels. Rate cuts of 2.25% since mid-2024 have not triggered a recovery. New Zealand first home buyers got the crash they're kind of waiting for, but they're still locked out. In New Zealand, even after the prices drop 30%, once you adjust for inflation, the average house still costs 7.2 times the average income. This is a crash a lot of first home buyers were waiting for, and it arrived, but still housing is deeply unaffordable there. Why? Well, when prices fell, banks tightened the lending. Loan to value ratios got stricter, deposit requirements went up. The crash that was supposed to help first home buyers get in the market actually locked them out harder because the only people who could buy in a falling market were cashed up investors who didn't need a big mortgage. A first home buyer who waited for the crash from 2019 is now buying at roughly 2019 prices, except they've paid 4 years of rent, they've got less savings because the economy's weakened, and they couldn't get the same loan they could get before. So why can't that happen here? Well, New Zealand's immigration collapsed from 136,000 in 2023 to just 14,000 in 2025. That's a 90% fall. Supply actually met demand. Their market had the ingredients for a real correction. Australia's immigration is still running at almost 500,000 people per year. The CGT and negative gearing wildcard. Now I need to address something I've been asked about a lot lately. What if the government changes capital gains and negative gearing? That's going to crash the market, right? As of April 2026, the Treasurer hasn't confirmed anything officially. But in Feb, he was basically confirming the government is looking at changes. Senator David Pocock had proposed scrapping the CGT discount for new property purchases after July 2026, but existing owners will be protected. Let me give you the honest picture. The industry coalition, so master builders, HIA, Property Council, modeled the double whammy scenario. Remove negative gearing for new buyers and halve the CGT discount. The result? GDP falls by over $3 billion, new housing starts fall by 46,000 over 5 years, rent rise an additional 1% per year on top of what they're already doing. Is that industry spin? Well, yeah, partially, definitely. But the government's own budget office looked at it and said prices would drop between 1 to 4%. So not a huge amount, unfortunately. But here's something that's shifted in the last few months. With a potential recession on the table and an oil crisis creating a real economic uncertainty, the political appetite for these changes could shake confidence further. And who knows what's going to happen, really. The government may not want to rock the boat when the boat's already effectively been rocked. I think all that stuff aside, the honest answer for first home buyers is these changes are designed to slow down the investor. They're not designed to necessarily make houses cheaper for everyone else. And if we look at the international evidence, it's pretty clear. New Zealand stopped letting landlords claim their loan interest as a tax write-off in 2021, specifically to help first home buyers. Rents went up. The government reversed it in April 2025. Canada raised its capital gains tax in 2024, and the Prime Minister cancelled it in March 2025 before it even kicked in properly. The only thing that's going to fundamentally change first home buyer affordability is supply. And we're building 160,000 new dwellings per year against the 224,000 that we need as a minimum. Listen, it's not to say CGT changes aren't worth watching, but it's definitely going to cause a massive price collapse that's going to make it a lot more affordable for first home buyers. 1 to 4% isn't going to make a massive difference in the scheme of things. The one number that should decide. Okay, so remember at the very start I said there's one number you should actually decide on whether you should buy now or wait. It's not the oil price, it's not the cash rate, it's not your deposit size, it's definitely not whether you think a crash is coming. The number is, how long do you plan to hold this property? Because here's what 30 years of Australian property data tells us. In almost all cases, anyone that's held a property in Australia for 5 years or more, in any market, any cycle, any city, hasn't lost money. Now, there's going to be caveats to that, obviously mining towns and that sort of stuff. But if you look in the major cities, if you held a property for 5 years or more, you didn't lose money in the 1990 recession, those 17.5% rates, not in the GFC, not in the APRA correction, not in 2022, not ever. Ultimately, if you're buying to live in it for 5, 7, 10 years, the crash question almost becomes irrelevant. Even the worst case I can model, a 10% fall next year. If you bought something you can afford to hold, here's what will happen in 5 years. You're going to be up 153 grand on a 10% fall scenario, provided you hold the property for 5 years. But what about the best case? Same property, no crash, just 30-year average growth of 6.4%. After 5 years, your $1 million property is worth $1.364 million. Compare that to renting for 5 years. At $700 a week, say the Brisbane median price, you'd spend $182,000 in rent over 5 years, building no equity. And rent has been going at 5.7%, so every year that number goes up. Yes, a mortgage is more than your rent in dollar terms right now, but after 5 years, that mortgage, which you've paid down around $66,000 in principal, and if your property has gone up modestly, you're sitting on $150,000 plus in total equity. That's real wealth versus $182,000 in rent receipts. But, and this question matters more than now than ever, the real question isn't just, can I hold it for 7 years? In the current rate environment is, can I hold it for 7 years at 7 to 8%, say? Stress test yourself at, say, 7 or 8% variable before you buy. Not 6%, not at current rates, 8%. On a $730,000 home loan, repayments at 8% are roughly $5,300 to $5,400 a month. That's about $1,200 to $1,300 a week. Can you hold that for 7 years? Not forever, just 7 years. Through the height cycle and say out the other side. If the answer is yes, the data is overwhelmingly on your side. If the answer is no, don't buy yet. Not because of the market, because of your financial position. Get your income, savings, and buffer to where that answer becomes a yes. So what should you actually do? I think firstly, stop asking will it crash and start asking can I hold for 7 years at 8%? They're completely different questions. You don't have a crystal ball with one. The other, you have certainty. You can work that out on paper today. And it's a yes or no question. Can I afford that for 7 years at 8%? If I can't, well, keep saving and build up that buffer. Step 2, get your borrowing capacity assessed today. If you're thinking about buying, like I said earlier, there can be a massive gap between one bank to the other in terms of your capacity. At Hunter Galloway, we help home buyers all across Australia. We can do a free assessment, so use the link below to reach out. And 3, build a 6-month buffer. If you're really concerned about it, try and build in a 6-month buffer on top of your deposit for when you buy that home. So then you're sitting pretty. If something happens to your job, if you get sick, you've got 6 months of repayments as a buffer ready to go to protect you. Wrapping up, obviously no one has a crystal ball and knows what's going to happen next. The oil crisis is new, the rate hikes are new, the recession risk is real. I'm not going to stand here and tell you it's all going to be fine because who knows. But what I do know is this. Australia is still short by 200,000 houses and our population is still growing. And if you stop paying your mortgage here, the bank comes after everything, which is why Australians don't walk away from their homes like they do overseas. That prevents the domino effect that crashes the markets. And 30 years of data spread across 5 separate corrections, including one with interest rates at 17.5%, says that provided you can hold, afford the higher repayments and weather the storm, it'll work out fine. So the question is whether you can hold in this rate environment at 8% for 7 years. Answer that honestly and the rest will take care of itself. Thanks so much for watching. If you like this video, drop waiting in the comments below if you're waiting, or go if you're looking at buying this year. If you need any help, hit us up at huntsgalloway.com.au. We're the home for home buyers across Australia. And until next time, guys, I'll see you later.